So, you are a non-UK resident and you're still earning money from the UK. You probably think that income is safe from the tax man, right? Well, be careful because a very simple mistake could end up costing you an absolute fortune. Today, we're going to demystify a crucial UK tax rule that every single non-resident needs to get their head around: disregarded income.
Now, this guide comes directly from the experts at My Tax Accountant. They are on the front lines, and they see every day how these rules can literally make or break someone's financial plans. So with their help, we've put together this breakdown to give you the clearest possible picture for the upcoming 2026 tax year.
Okay, so let's imagine you're living abroad, maybe somewhere sunny, but you're still getting income from the UK. You're officially non-resident, so you're totally in the clear with UK tax, right? You know, it's a really common thought, and it can be a dangerously wrong one.
Take a look at this number. That is not a lottery win. It's a shocking, nearly £400,000 UK tax bill. This is exactly what one person had to pay, all because of a simple misunderstanding of the rules we're about to cover. The stakes here are incredibly high.
All right, here's our game plan. We'll kick things off with that shocking tax bill story. Then we'll define what disregarded income actually is, look at a really important tax calculation choice you have, and expose the hidden traps. Then we'll wrap it all up with the key takeaways and your next steps. Let's get into it.
First up, that staggering £400,000 tax bill. And look, this isn't just theory. This is a real-world story of how really bad timing can lead to a financial disaster.
Let's meet Justin. He owned a really profitable UK company and had a plan to take out a large chunk of cash. Now, to do it as tax efficiently as possible, he moved to Dubai for a new job, officially becoming a non-UK resident. The plan seemed foolproof: become non-resident, then take the money. Sounds logical, doesn't it?
So here's how it all played out. Justin moves to Dubai on the 1st of June 2026. Now, under what's called the split-year rules, which basically slice the tax year into a UK part and an overseas part, he's considered non-resident from that day forward. So far, so good. Just 2 months later, he pays himself a £1 million dividend. He's non-resident, so he's thinking, brilliant, this is tax-free. He was wrong. His accountant had to deliver the absolutely crushing news he owed almost £400,000 to HMRC. But why? Let's find out.
The key to Justin's massive mistake, and how you can avoid making the same one, is a concept called disregarded income. Now, I know it sounds like a bit of tax jargon, but trust me, understanding this rule is the difference between saving a fortune and losing one.
So, what is it exactly? Well, to put it simply, disregarded income covers certain types of UK investment income. For a non-resident, the UK tax you owe on this specific income is limited to any tax that's already been deducted at the source. So if nothing was deducted, your UK tax bill on that income could be zero. That's a huge advantage for non-residents. Now, this slide makes a really critical distinction. On the left, you've got the income that qualifies. Think of it as passive stuff like UK dividends and bank interest. But on the right is what's not disregarded. And this is key. Income from, say, your UK rental properties or a UK salary is fully taxable. You can't just ignore it. Getting this distinction right is the very first step to getting your tax return correct.
And this leads us to a crucial decision you have to make. If you've got a mix of these two income types, some disregarded, some not, you actually have a choice to make. You can't just pick one method and hope for the best. You really need to calculate your tax bill 2 different ways, and then choose the one that saves you the most money. So the big question is, how do you figure out what you actually owe? Well, it's not always straightforward. HMRC gives you 2 options, and you get to pick the one that works out best for you. For simplicity, let's just call them the normal method and the special method.
Okay, let's take an example. Meet Sam. He's a non-resident, he's got £40,000 in UK rental income, plus another $15,500 in UK dividends and interest. Under Method 1, the normal way, he combines all of that income and gets to use his personal allowance. His tax bill, £8,062. Now, under Method 2, the special way, he gets to disregard the investment income. He only pays tax on the £40,000 property income. But, and this is the catch, he loses his personal allowance. His tax bill this way is £8,460. And that shows the difference perfectly. By choosing the normal method, Sam saves nearly £400. Now, that might not sound like a life-changing amount, but with different numbers, the savings can be absolutely massive. The key takeaway is this: you must run both calculations every single time. Good tax software often does it for you, but understanding why it's doing it means you can double-check its work.
So you know what disregarded income is, and you know you have to compare the 2 methods. You should be all set, right? Well, unfortunately, no. That's not all.
here's where most people get caught out. There are two huge traps that can completely ruin all your careful planning.
And here it is. This is the crucial detail that Justin completely missed. Pro tip for you, the special rules for disregarded income only apply if you are non-resident for a full UK tax year. That's from April 6th to April 5th the following year. They do not apply in a split year, the year you actually leave the UK. This is the bit of fine print that created that £400,000 nightmare. Stay with me, the next slide shows you exactly why.
This slide just lays it out perfectly, doesn't it? Justin took his dividend in August 2026. This was during his split year. Because of that one fact, the special disregarded income rules didn't apply, and his dividend was fully taxed in the UK. The result? A massive bill. The solution was painfully simple. He just needed to wait. If he had taken that dividend literally any time after April 6, 2027, he would have been in his first full tax year of non-residence. The rules would have applied, and his UK tax on that £1 million would have been zero. A simple timing change with a $400,000 consequence.
But hold on, there's a second trap. We'll call it the returner's trap. This one gets people when they move back to the UK. It's officially called the temporary non-residence rule. Basically, if you return to the UK after being non-resident for less than 5 full tax years, HMRC can actually claw back tax on income you received while you were away, including those dividends you thought were totally disregarded. So if you're planning a short move abroad, you have to be extremely careful. To be safe, you must stay non-resident for 5 complete tax years.
Okay, we've covered a lot of ground here. A really costly mistake, a key tax rule, a crucial calculation, and 2 major traps. Let's try and condense all of that into a simple checklist.
So here's your checklist. Number 1, confirm your residency status. Don't guess. 2, separate your income into disregarded and non-disregarded. 3, always calculate your tax both ways to see which is cheaper. 4, watch out for those traps, the split year timing and that 5-year returners rule. And finally, number 5, keep meticulous records of everything.
Look, understanding the rules is the first step, but applying them correctly to your personal situation, well, that's the real challenge. So, what's your next move?
This quote from some tax experts really says it all. Tread carefully. As Justin's story shows, that's a massive understatement. A small mistake with big numbers can have absolutely life-changing results. Getting professional advice isn't a luxury, it's an absolute necessity.
And this is absolutely vital to remember. This has been a general guide, not personal advice tailored to you. Your own circumstances, where you live now, international tax treaties, all of these things can change the final numbers. So before you make any decisions, you absolutely must speak with a qualified tax expert.
If you're navigating this complex area and you need that expert help, the team at My Tax Accountant, who helped shape this guide, are available. You can call them on 0208-570-8531 or email them at the address you see on the screen. For a really detailed breakdown of everything we've talked about, check out their article. And for more clear tax guides just like this one, make sure you subscribe. The question I'll leave you with is this: are you absolutely sure your timing is right? Thanks for watching.